Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here's your weekly technical analysis of Chicago wheat and corn. Chicago wheat. The break in early October last year below the August to October ascending wedge pattern was a seminal moment here. 13 weeks ago I laid out two avenues on what I thought might be the possibilities here. The market chose the first avenue and moved lower. I said at the time, and I quote, "The straightforward move down with potential targets for the ascending wedge pattern, thus a primary target X on the downside was already achieved in the 860 area, whilst a secondary harder to reach target X1 is way down below in the 712 area." End of quote. Since then, prices have dropped below all the moving averages, and in early December, prices pushed down below last August's low of 743. The lowest low and low close since late September 2021. In the process, we also saw prices move down in January below the March 2014 high at 724. However, that seems to be enough, as the March 2014 high is part of the congestion band 725 to 721, which also has the October 2013 low at 721 within it. The move down in early December last year and again in January this year halted there. Below this 725-721 zone, there appears to be no clear support until the January 2021 high at 693. So it was a close run thing. Prices have recovered since January, but it has been a very slow process and the recovery has been limited. You see, overhead we have congestion created during July and August last year between about 780 to 843. Inside this congestion is a slowly declining medium moving average, currently 814. And until recently, the declining short medium moving average, and that's actually currently now 763. This latter moving average has now dipped down to mix it with the market, and whilst not clearly pressing prices lower, it has influenced activity, such that the last 2 weeks have been a sideways action overall, though that is coming to a finish now. You see, 2 weeks ago I laid out two possible scenarios going forward, and I quote, "Primary focus is on what has developed from a bear channel into a descending expanding wedge pattern, highlighted in bright green on my daily chart, and originating from October last year." That's currently at 555 to 747. The upper trend line here has had the added benefit of the short medium moving average entwined about it since late November last year. There is a further focus, and one that may take up the running from this wedge pattern, and that is to look at the whole May last year to date action as a possible large double bottom, even Eve type action. But this idea has diminished since prices made a new low this week. End of quote. Well, my thoughts back then were that the descending expanding wedge pattern was the leader in lower markets, as it had the short medium moving average entwined around the upper trend line. However, today we're above both the upper trend line as well as the short medium moving average, and the idea of a double bottom even Eve type is back in front. Before we start zeroing in on this concept, let's take a look at the descending expanding wedge pattern and what a break higher may mean. In this pattern break, we have a potential primary target X2 in the 950 area, and a secondary and much harder to reach target X3 in the 993 area. Now, before we all get carried away with these bullish ideas, it's best to take a closer look at these patterns. So the descending expanding wedge pattern does exist, but prior to the move higher, it was at most a 2.5 pointer on that side, as the rise at the end of December last year shied away just short of the upper trend line and making it a 3-pointer and more legitimized. Likewise, the move above the short medium moving average has been uninspiring so far. So altogether, we should have potential targets topside, but as to whether this market will go for them, well, right now I'm not that confident of that. Not at the moment, not at all. Chicago corn. Well, how interesting has this chart suddenly become? I've said for many weeks now that this chart was a headache, with so many things going on all at the same time. However, it does seem to be all settling into a pattern order. But first, before I discuss that, let's set out the key elements that are impacting this market. Firstly, is the impact of the long moving average, currently at 676. This has been a de facto bearish trend line for the last 3 weeks. Then there's the July to October 2022 ascending wedge pattern, highlighted in red trend lines on my daily chart. I personally found this to be the most elegant of all of the elements. In mid-October, the market exited this pattern with a primary target in the 648 zone and a secondary harder to reach, well, much harder to reach target X1 in the 550 zone. In early December, prices dropped down enough to reach the primary target, but we have not even tried down to the secondary target, and I am now considering retiring it completely. I now come to these two key and recent elements of the market. The first is the lower time, currently 668, of the July to December 2022 bullish shift pitchfork, which I've highlighted in bright green. And secondly, the neckline, currently at 689, of the November 2022 to January this year reverse head and shoulders pattern. Now you can look at these two recent elements on their own, but I would urge you to look at them combined into a new pattern, an ascending, expanding wedge pattern. The elegance of this pattern is absolutely sublime, especially as it has been made from two separate patterns. Currently, the pressure is for a break lower as the long moving average is squishing the market lower. But I will not set out any targets for this pattern until one or other of the trend lines is properly broken. But I can give an idea of the size of the moves likely. Thus, for a confirmed break lower, it would have a primary move of about 13 cents below, and a harder to reach secondary move of about 42 cents below. Alternatively, a confirmed break high would have a primary move of about 26 cents higher, and a harder to reach secondary move of about 42 cents higher.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.